This is Nadir back in Chicago, and you are watching my channel, Knowledge for Quality of Life. Friends, last week I came back to Chicago, and I apologize that not doing the vlog last week due to time constraint. It was very relaxing, and we were spoiled. Me and my wife both were spoiled by my son and my daughter-in-law, and we didn't even visited once in the kitchen and didn't do any cooking at all for 10, 12 days while we were there. And I was fortunate enough to meet my oldest friend. When I say oldest means they are very young from heart, but they were my classmates back in my undergraduate studies back in Karachi in Pakistan. And those were my colleagues. Last time I saw them back in '86, and this is the first time I saw a few of them. And one particularly friend visiting from Karachi, Pakistan, I met him as well. So it was quite relaxing, and I'm glad to be back and be connected with you guys. From time to time, as I said in the past, that I do vlogs on three areas: education, finance, and health. So far, I've been doing more on health, and some I started with finance also. Based on my experience over the last 35, 40 years, I haven't touched anything on education yet. And some of my friends, some of my colleagues may think that how much I share here, what are the bases, what kind of a qualifications I have. And by no means I have ever, claimed that, I'm an expert, but these are practical experiences, and I'm a vivid reader. I do my due diligence, I do my research, I took care of a lot of things in life, and I don't rely on expertise on common things, which we can, easily educate ourselves. And the whole life is about learning. So I made my objective in life that learn. And over the years, I have come a long way. Particularly in the last 10 years, I have grown quite a bit in learning things. And today, before I get indulged in the topic of today, I wanted to welcome all those who joined the channel recently. And please, I request, this is my humble request, that if you have any particular topic or any particular life situations you want me to discuss, if I have gone through that, I'll be happy to address those topics as well. So please include in the comment section, and I will try my level best to address, in a timely manner. So today's topic is sometimes, overlooked and not talked about quite frequently. It's about life insurance. And some of the things which I'm going to be sharing here may be new to you, maybe not talked about quite frequently. And some of the insurance agents may not like this talk at all. And this is my personal experience, and I digged quite a bit over the last 35, 40 years when I was growing myself as a family and early in my career. So before I start this discussion, I wanted to share some concept about protecting one's life. So life insurance, by no means, I'm a life insurance agent, but the concept I'm trying to illustrate here is for the clarity. Uh, when somebody buys life insurance, it means that there is the person is underwriting the risk of his or her life. That in case if he or she passes away, then the family who gets the proceed, they can replace the breadwinner's income. That's the main purpose of buying a life insurance. And we will look into it, the types and all that. So there's a concept when you deal with life insurance is concept called theory of decreasing responsibility. So let me share my screen with you so that you can follow me what I'm about to share here. So what you see here, the graph or the picture, this is called theory of decreasing responsibility. So in around the x-axis, you can assume that as we age. So x-axis, you can assume that this is the age axis, and the y-axis here along this is one's liability and assets in dollar cents. So when we are young, when we are starting a career, when we are starting a family, we don't have much money, because we are just starting, and the liability is huge here, all right? Because, we don't have lots of, assets because, the loans are there, the mortgage, if we bought a house or some student debt, which we borrowed money for our education, and high debt mortgage, children are young, it's a huge liability. So in case if God forbid something happens to the main breadwinner, and the bills are not going to stop coming, and the family needs to have enough pot money pot so that the person's income can be replaced. So basically, there's a huge liability here. That's why the curve is high for the liability. Need for protection is the maximum here. And not much money saved here. So assets, your saved assets are pretty much none here. As we age, as we move along the axis, as we age, our assets tends to grow, our savings tends to grow, and a good amount is saved throughout 25, 30 years or 20 years as we move on. So we have money saved up a little bit, and the assets has grown as we age. Now, at the same time, the liability dwindles. As we age, the liabilities goes down because the kids are grown up, the kids are through the college, they are self-supporting, they are probably starting to work after graduation. The mortgage is going to be probably paid off if somebody has a mortgage acceleration program. The 30-year mortgage, if you pay a 1 year extra payment yearly basis towards your principal, your mortgage can be paid off in 22 years. So mortgage can be paid off. Now, it means that, close to as we age, our children are grown up, they are on autopilot, the debt is almost none, mortgage is paid off, and we have quite a bit money saved in the retirement or in our accounts. So it means that, if you look at these two curves where they're intersecting, okay, where they're intersecting, this point of intersection tells us that, at one point, beyond this point, your assets are going to be more than the liability, okay? So it means that beyond this point, you don't need theoretically any life insurance coverage, because if I have 100,000 or 200,000 saved up in my bank account or more, then why do I need a life insurance for my whole life? The most you can assume that for bereavement purposes you need 10 to 20 grand. That's all. And if you are in burial scheme, even though you don't need that much, because I don't have any bereavement plan, because I'm part of the community where we have a burial scheme, and that takes care of it. I have to pay yearly whatever the nominal dues are, and I'm covered from that perspective. So it means that this point, beyond this point, you don't need any life insurance coverage, in essence. So this concept of increasing the assets and decreasing the liability. It's called theory of decreasing responsibility, because as we age, our responsibility goes down. And in a way that beyond this point we are self-insured. So let me stop share here and share another screen. And I made a query, and I was asking this to ChatGPT. And before I go into that, I wanted to share some, back in '89, I read a book. And if you can get your hands on that book, I strongly, strongly recommend to read that book to have a better understanding the way I understood things from that book back in '89. And still it's in my head. And the name of the book is What's Wrong with Your Life Insurance? And the author name is Norman Dacey. And I can include that book, name of the book, in my description, and link as well. So if somebody wants to read it, they can borrow from the library. You don't have to buy it. Local libraries carry that book. That's where I got it. Back in '89 in the reference section, or in the, you can check it out as well. So the same concept which I am illustrating here, which I made a query to ChatGPT, and same concept is illustrated here. And I'm telling you that nowadays, as I said in the past in my different vlogs, that we are living in an information technology age. So you can have all these queries made and use your intellect to filter things out. Because sometimes I argue with ChatGPT, and they correct things based on the information available. And if you have information available through the credible paper or citing resources, you can give it to them, and they can correct it. This is an amazing tool. And I made a query that what is life insurance, which I explained you. When do you need it most? Is it better to buy level term insurance, level term, or whole life insurance? So it gave me a series of responses. Life insurance is a financial product that provides payout, as I explained, called a death benefit, to your beneficiaries if you die while policy is active. It's primarily used to provide financial protection to dependents on or others who rely on your income. So basically, it's a lump sum proceed for which you are insured to your loved ones, so that your income can be replaced. Now, when do you need the life insurance most? Again, the concept of theory of decreasing responsibility, keep that in the back of your mind. You have dependents, right? If you have a spouse, children, anyone who relies on your income, and your living expenses, your education, your kids' education, your kids' college expenses, and in case if somebody passes away, which in this case, the main breadwinner. You have a debt, you have a mortgage, you may have co-signed something, and student loans, etc. You want to leave an inheritance, some kind of a tax efficient asset for your hires. And you want to cover financial expenses in case if you need for bereavement purposes, or you have a business. So type of insurance is one is term insurance. It's called renewable term, means as at your birthday, the term insurance gets renewed, and you're, of course, you are aging, so your term policy premium is going to be increasing. I personally took, when I was growing old, in my back in '89, I bought a life insurance level term for 20 years, because I figured it out that beyond 20 years I will be self-insured and I don't need any more life insurance. And that's what I did, and that's what exactly happened. So now, in those days, 30-year level was not available, but now you can buy in 20-year level, 10-year level term, 30-year level term, and this is the cheapest option, and best for most people with temporary needs until kids are grown or mortgage is paid off. You remember the theory of decreasing responsibility. If you're liabilities are going down and your assets are building up, you don't need any life insurance beyond that point. Okay, for general population, for most of the population. Now, level term life insurance, give you both premium and death benefits stay the same throughout the term. Best for people who want the most predictable cost and coverage, because this is the cheapest form of life insurance one can buy, and versus the whole life. Whole life insurance, a type of permanent insurance, probably lifetime. The insurance companies loves it because you keep paying this premium for the rest of your life, and you don't get that kind of a benefit as compared to the level term insurance, which we will look into it in an illustration down the line. So cost is much more expensive than the term. This is more expensive. So what happens that, when you deal with any life insurance agent first, and they will tell you that, you don't build, in level term insurance, your premium goes down the tube because, you don't build any cash values in the policy. Your dividends are not going to be there, and blah blah blah. And that's the selling point they mostly they give to the customer. And by certain ways they get you in trap that most most of the people I've talked to in the past, that they bought a whole life policy because of this fact that it's going to build their cash values. And the cash values don't build that way. Whatever the pictorial or fancy computer outputs they generate, because there are certain assumptions, and what if those assumptions may not fulfill? So that's one thing. The second thing is that if it's your cash value, then when you want to borrow, they'll tell you that you can borrow against it. So you have to borrow it, then you have to take it as a loan, and for which we have to pay the interest. And so there are lots of strings attached to it in the fine prints, and most of the people don't read those fine prints, and that's the caveat. And then if you normally, rule of thumb is that to replace breadwinner's income, you have to take at least 10 to 15 times the annual salary of your life insurance coverage. So if, for instance, in today's age, if somebody is making $150,000 a year, 35-year-old male non-smoker, then probably the person needs to take at least 1.5 to $2.5 million at least to replace his or her salary in case if the proceed gets to the family. Because you don't want some kind of a life insurance just to have the life insurance that it may not generate enough income without touching the principal. Because that's the whole idea. Because if your if your loved ones gets the proceed, that they can put this proceed away somewhere in a decent scheme, or they can live off the interest without touching the principal. Because if somebody has a 200 or 300,000 policy, probably it's going to be wiped out in 2.5 years or 3 years at the most. And then after that, what? So that's the concept. And sometimes when they sell this whole life policy, the customer says that because of the expenses, premiums are so high, they said, well, I cannot afford this kind of a policy. And then they'll say, okay, how about if you can afford $100,000 or $200,000? So they underinsured you just to make sure that the premium is affordable to you, which may not be conducive at this time. It may seem okay, but guess what? That if I kick the bucket, my proceeds, which are going to be given to my family members, it's going to be not enough to generate that my income. My replaceable income, for which the life insurance should be taken. These are the pitfalls which a whole life policy carries. So you have to be very, very mindful of that. Includes cash value that grows tax deferred over time. That's the selling point they give you. best for high net worth individuals, estate planning, and lifelong dependents. I'm not sold on this idea either. So, uh, which is best? So, your family, mortgage, income replacement, this is the situations. And best option is level term 20 to 30 year. Budget conscious needs coverage during working life term. For folks who are high net worth, estate planning, wealth transfer, permanent needs, whole life. And again, I'm not completely sold on this idea either. So even though ChatGPT is telling me, I'm not sold on it. You want coverage plus an investment element, possibly whole life, but usually not worth it for most, as I said. So the whole concept is that, if you buy the term and whatever that you are supposed to pay in the whole life policy for that amount, you invest yourself that difference. And we will look into the next, illustration. So I made queries after the queries, because I was talking to ChatGPT. So final thoughts, for most people, especially young families or those with temporary financial obligations, level term insurance offer the best balance of affordability and protection. Whole life insurance has its place, but it's often oversold by the agents, okay? Because of various reasons which I have explained to you. It's expensive, it's very expensive, and better suited for specific financial goals, not for general public. Uh, you know, uh, Always buy enough coverage to replace your income and cover the liabilities in the early years. A common rule of thumb, as I said, 10 to 15 times or your annual income. Basically 100,000, let's say 150,000 somebody is making, then probably you need 1.5 million. And if somebody is, at least minimum 1.1 million. Um, if somebody is making 150,000, 15 times of 150,000, 15 times of $150,000 is going to be 2.25 millions. So probably in the vicinity of 1.5 to $2.5 million will suffice, that in case if your beneficiary gets that proceed, they can put it away somewhere in a decent dividend generating income vehicle, so that it generates the replaceable income of $150,000, without touching the principal. That's the whole idea. So I asked the ChatGPT later, give me a recommendation for person making 150,000 a year. So this is the recommendation. I got it. Level term 20 to 30 year. This is the option depending on where you are situating yourself 20 to 30 years from now. And then recommended coverage amount was 10 to 15 times of your annual income, which is 1.5 to 2.25 million. This amount would be replace your income for 10 to 15 years. Cover mortgage debts and everything, fund for your kids' college in case if something happens to you. Help your family maintain their standard of living. Again, this standard of living means replacing the breadwinner's income. So you get the proceed, you put it away somewhere in income generating instrument, and you live off the income, the dividends and in interest, without touching the principal. Recommended term length, life stage, young family, kids less than 10 years old, recommended term is 30 year. Kids in teens, mortgage, and soon 20 years. No dependents, just final expenses. Consider short term or smaller amount. This is for burial expenses. And if you are part of the burial scheme, you don't need it even. Just like I was part of the burial scheme uh, in my community, I never bought it, bereavement expenses. Why not whole life? Okay, usually because whole life could cost 10 times more for the same coverage. The money spent, the money is better spent investing separately in your 401k, IRA, or brokerage account, or your regular account, because if you are saving separately on your own, whatever the difference is, that money you control. You know, you are not, under the umbrella of some life insurance policy that, if you have to borrow that money, you have to take it as a loan, because, that money, that cash value belongs to you. Why would it be considered as a loan to begin with? This is the toughest thing I could digest. And I had a very huge discussion, back in '89 when I was buying the life insurance, and the agent was trying to sell me the whole life policy, and I was asking all these questions to the gentleman, and finally he said he offered me a job, because he thought that I knew so much, so he tried to recruit me for the company, and sell the policy, whole life policy, because it's a life, it's a money making machine for the insurance agent. Paying down debt, building emergency savings. So this is the sample for monthly premium estimate for healthy 35-year-old non-smoker. Level term, if somebody buys level term, coverage is, let's say, 1.5 million. Level term is 20 years, means your premium is going to be staying same for 20 years. Okay. The monthly cost for AM Best company, A plus rating, varies between $45 to $60 a month. This is a month. Level term, 2 million policy, 30-year, it's going to cost you $85 to $110 a month. But if the same person goes for whole life, 1.5 million, lifetime, because you keep paying till lifetime until you kick the bucket, and the monthly cost is $1,000. So let's say if somebody buys level term 30 years and $110. So here, you take the difference, and then I made another query to this ChatGPT, that if I buy the term and invest the difference, what would happen, 20 or 30 years later? So, I don't want to build this cash value into the whole life scheme, because I want to buy the maximum protection during those first 20 years, beyond which I will be self-insured and I don't need to pay any life insurance for the rest of my life. Okay, that's the concept. So if I take the difference between these two, whatever I'm supposed to save, avoiding the whole life policy, and I invest in any good mutual fund and let it grow. And that's the same concept Norman Dacey is illustrating in the book, What's Wrong with Your Life Insurance? Because, this thing is insane. How people have been unintentionally cheated, because I say that, this whole life policy is going to make a hole in your life, basically, because you keep plugging these numbers, these dollar amount, and your cash value is not going to grow over time. So I made another query, here, why whole life policy shows zero cash value in first couple of years. Okay. Now, when you buy, you have a discussion with the insurance agent, and they give you a fancy printout. You see that first couple of years, around 3 years, your cash value is going to show zero. Okay. And then you are going to build some cash value to it. So this is the query, and I read this thing in that book by Norman Dacey. So I made a query, and the ChatGPT is saying that great question, and it reveals one of the most important drawbacks of whole life insurance policy. Why whole life shows zero cash value in first years? Whole life insurance typically shows zero cash value for the first 1 to 3 years because of high front-loaded fees and commissions. Okay, mind that. High front-loaded fees and commissions, which the company is making and the agents are making. A large portion of your premium goes towards sales commission, administrative cost, and insurance company overhead in the early years. Agents can earn 50 to 100% of your first year's premium as commission, meaning your money is not building value yet. That's why the cash value is zero. Now, they have a vested interest. The agents has a vested interest in selling you a whole life policy because they're going to make a ton of money in commission rather than selling you a term insurance where the premium is very minuscule. They're not going to make a whole life yearly premium, first year commission. So they have a vested interest in selling you a whole life policy. So please be mindful of that, because this is the biggest, uh, you know, uh, stuff I have seen in the last 35, 40 years. I've been talking to various folks over the years. They said that, oh, I've been paying my cash value whole life policy for the last 20 years or 30 years. It's not building the cash value as it was predicted in the fancy printout, which I was given to begin with. And that's the reason. Slow cash value growth. Whole life policy are designed to accumulate cash value slowly but steadily. Uh, and sometimes, it hardly beats inflation in the long run, because you have to factor that inflation. Remember we talked about in my previous vlogs how it erodes your purchasing power. The policy cash value doesn't even begin to accumulate until the insurer recoups its early cost. Okay, so that's a big one. Guaranteed and non-guaranteed growth. The guaranteed portion of cash value grows slowly. Dividends non-guaranteed may increase value over time, but not early on, because your first 3 years cash value shows zero. You see that? Example of typical policy breakdown, year 1 to 3. That's how your premium paid, let's say 10 grand, yearly premium. Your cash value is zero, and then by third year you will see. So by year 10 you may start seeing substantial value, but it can take 15 plus years just to break even. Total cash value equals to total premium paid. Okay, it's gonna, so whatever you paid, it's gonna take 15 plus years to break even. Okay, bottom line, whole life insurance is not a good short-term investment. The cash value component is slow to build, especially in the early years. You pay a lot of upfront before seeing any real return. So whole life might make sense for certain individuals. That's what ChatGPT is saying. But still, I'm not sold on that idea. I never ever bought myself any whole life policy or any cash value insurance. So uh, this is the I asked that, give me a illustration between the comparison of whole life, if I were to buy whole life insurance, or the second option would be buy the term insurance and invest the difference myself. So we are assuming here 35-year healthy non-smoker, yearly income is 150,000 a year, coverage is 1 million, time horizon for level term is 30-year. Investment return, I conservatively assume 7% annually. Whole life premium is going to be at 9,000 a year. Okay, 9,000 per year my premium for typical $1 million policy, and term life insurance premium 500 per year. So the difference between 9,000 and 500 is 8,500. Okay, so it's for the 30-year level term. So now it gave me an illustration of whole life. My 9,000 premium is going to be growing like this. Okay, so death benefit for up to 40 years. The break-even point is going to be typically between around 15 to 17 years. Cash value grows slowly early on, then compounds modestly because of various reasons which we discussed earlier. So after 40 years is going to be 30 years is going to be 1.1 million. Your premium paid here. This is the premium how you're paying, based on your early. Your cash value is going to be built, and then death benefit. If something were to happen, that death benefit is going to be paid out. Now this is the cash value is increasing. See the difference here. That premium paid is at 30-year $270,000, and the cash value is merely 250,000. Now let's compare to the term, buy the term and invest the difference. So you're buying a 30-year level term, and your premium is going to be 500 per year. So you're investing yourself. Now remember that here, if you were to borrow any loan from your cash value, you have to take the loan out, okay? Because this money is under the umbrella of a life insurance. You don't have a control over it. But here, if you are buying a term and invest the difference in some good mutual fund, even in index 500, okay, S&P 500 on your own, you're going to generate better returns, 9 to 10% over the long run, better than 7%. But conservatively assuming 7%, 30-year, you paid total invested this much, and your investment value at 7% is going to be $925,000. So 30-year, your death benefit is going to be 1 million, because that's the life insurance policy is for. And beyond 30-year, your insurance policy is going to expire. It means that if somebody is expiring this policy, it means that you don't die, you don't get it, right? So basically, you are self-insured by this point, because your investment value is going to be close to $1 million. So beyond this point, you don't need to keep 1 million death benefit insurance policy if you have saved up this much. So basically that point where it intersected, I showed you earlier in theory of decreasing responsibility. Beyond that point, you don't need any life insurance policy to keep for the whole rest of your life. Okay, and that's the beauty of it. That more liquidity in this case, because it's not under the umbrella of life insurance, because you are creating your separate account, and you are assigning a beneficiary. If something happens to me, my family, my wife is going to get this much amount directly from the company where my account is, because she is assigned as a beneficiary. Okay, and so it's more liquid, greater growth, but term ends after 30 years, and that's okay. In my case, I had a 20-year level term, and beyond that, insurance company was pushing me to renew beyond 20 years, because they keep expecting this premium for the rest of my life, and that's how they make money. You see all the downtown big cities, the tallest buildings you see that owned by the insurance company. That's where our premium goes, basically. So it's a money-making machine for them. No death benefit past 65 unless you buy the new coverage or self-insure. So basically, in a nutshell, feature summary: premiums, whole life is a lot higher. Term plus invest the difference or invest the rest. Premiums are low, and as compared to 9,000 a year, your premium is only 500 a year. Cash value early on 0, grows steadily because you have control over it. Death benefit duration lifetime. Here it's term related. Flexibility is low, but here you have a full control. Your beneficiary has a full control over your invested amount, and because it's in separate account, it's not tied with the life insurance. Long-term wealth, moderate, but here is high. Market returns, so your money is going to grow much faster here because you have invested. So let me stop share here. So basically, think about it. The concept here that the most expensive insurance in the industry is our health insurance. But did you ever hear that you buy the health insurance, and if your premium accumulates cash value? No, never. If you have a health insurance, you get sick, you get the benefit. If you don't get sick, you don't get to see the doctor, you don't get hospitalized, your cash value goes nowhere. You are not building any cash value. Your premium goes down the tube, period. But it's attributed, this cash value concept is attributed to your life insurance. You know why? Because actuarial scientists, the people who underwrite this risk and reward ratio, they know very well that we live only once, but we get frequently sick. Okay, so that's the concept you have to keep in the back of your mind. So probability of dying, uh, you know, versus probability of getting sick. Okay, so this this balance needs to be taken into the picture of paying out by the insurance company and making the money in premiums. So I hope that you got some idea about this concept, and it's very crucial to cover our family members, because if something were to happen, I'm going to kick the bucket, I'm gone, but I want to protect my loved ones. So having a life insurance, having a policy, having a coverage in the early years, uh, you know before we get financially stable and strong, it's very crucial. It's part and parcel. It should be part and parcel of the complete personal finance picture. So please, I request all the young folks who are watching this vlog that make sure that you are covering yourself, your loved ones, in a good way, and try to dig some information on yourself, by yourself, and don't rely on anyone. Don't rely on me. What I'm telling you, go and dig it up. Read this book, which I shared to you earlier. What's Wrong with Your Life Insurance? It will open your eyes, by Norman Dacey. And I will include the link in my description. So I hope to see you next week with something new. Until then, see you. Bye.